The Securities Exchange Act of 1934 is the foundational federal statute governing the governance, trading, and oversight of securities within the secondary market. Enacted by Congress to restore investor confidence following the 1929 stock market crash, the Act extended federal regulation beyond the initial issuance of securities, which is regulated under the Securities Act of 1933, and applied strict statutory mandates to ongoing market transactions, equity listings, and financial intermediaries. It also established the SEC, granting it broad administrative authority to oversee broker-dealers and national exchanges. The operational core of the Act relies on a tiered regulatory structure where federal authority is decentralized through a network of registered SROs. Under Section 6 and 15A, national security marketplaces and professional associations must register with the Commission and enforce internal compliance rules. Venues like the NYSE and NASDAQ act as frontline regulators, establishing listing standards and surveillance to monitor order books for irregularities. This tiered approach ensures that market participants adhere to high ethical standards and transparent trading practices. To manage systemic settlement risk, Section 17 mandated the creation of centralized infrastructure for trade processing. The Depository Trust and Clearing Corporation, or DTCC, and its primary subsidiary, the DTC, operate as the premier clearinghouse for equities. For listed equity derivatives, the Options Clearing Corporation, or OCC, acts as the sole issuer and clearing agency. These entities ensure that the delivery of securities matches the transfer of funds, stabilizing market operations during high-frequency trading. Section 15 mandates that broker-dealers register with the SEC and an SRO. This requirement extends to individual employees, establishing testing benchmarks. Professionals pass standardized exams like the SIE for fundamentals, the Series 7 for representative mastery, and the Series 24 for principal supervision. Additionally, state licensing like the Series 63, 65, and 66 tests state-level rules under the Uniform Securities Act. These qualifications ensure that every registered representative maintains the ethical baseline knowledge required for fair dealing. The integrity of secondary market trading depends on Section 9 and Section 10b, which outlaw deceptive or fraudulent behavior. Promulgated by the SEC, Rule 10b-5 is the primary legal mechanism used to prosecute securities fraud. It makes it unlawful to employ schemes to defraud. This applies to public and private companies alike, prohibiting insider trading and manipulative tactics like wash trading. Firms must maintain strict internal boundaries, known as a Chinese wall, to isolate non-public information. Finally, the 1934 Act mandates continuous transparency through filings like Form 10-K for annual reports and Form 8-K for material corporate changes. This ensures secondary market participants have ongoing access to verified financial information. These mechanisms guarantee market transparency. Mastery of these rules is the bedrock of professional integrity. Thank you for joining this session on the foundational pillars of U.S. securities regulation.